FMCG stocks are favorite for people who want to bear low risk and earn a decent return of 10 to 14% year on year. The good thing about FMCG companies is that the demand for their product exists throughout the year. In today's video, I will be shedding light on the FMCG industry in India and reveal 3 stocks where I have personally invested in. With respect to the FMCG industry in India, you can expect to double your money in the next 5 years if you invest in fundamentally strong stocks. Hi everyone, my name is Harsh Srivastav. I'm an ex-investment banker, a business owner and a finance specialist. If you're new here, do smash that subscribe button and click on the bell icon so you don't miss out on any of my future videos. Now, a burning question that might arise in your head is whether this is the right time to accumulate FMCG stocks. Well, let me answer that for you. In the first quarter of financial year 2023, the FMCG industry was being challenged by high input prices because of inflationary pressures on palm oil and crude oil derivatives. One of the reasons why this increase in price happened was the Russia-Ukraine war. Also, due to high global liquidity post-COVID-19, there was an upsurge in demand for commodities. This led the FMCG companies to increase the prices of their product by 10 to 15%. But still, the gross margins of these FMCG companies shrinked by 2 to 5% as per ICICI's industry report. Thankfully now, there seems to be some signs of cooling down in inflation. The US Fed fund rate is increasing in a continuous fashion to curb further inflation. The crude prices have also witnessed a dip from June onwards. It is expected that in the coming months, the FMCG companies will have lower input prices and a chance for their margins to grow. Even if you see the nifty FMCG chart, you can clearly see that the moving average is showing an uptrend. Lastly, the disposable income is rising in both rural and urban areas, thereby giving a huge opportunity to FMCG companies to scale further. So it is definitely a good time to enter the markets and accumulate some FMCG stocks for the long term. Now let's talk about 3 FMCG stocks where I have personally invested in with the objective to get 14% CAGR in the next 5 years. Hindustan Unilever is India's largest FMCG company and has a portfolio of products that are so deeply penetrated that 9 out of 10 households use at least one or more of its products. HUL has a portfolio of 50 plus brands, out of which 16 brands have a turnover of more than 1000 crores. One of the reasons attributed to this successful brand portfolio is HUL's wide distribution network of 9 million plus retail stores. HUL has 3 business divisions: home care with brands such as Surf Excel, Vim and Rin, beauty and personal care with brands such as Vaseline, Clinic Plus and Lifebuoy, and lastly, food and refreshment with brands such as Red Label Tea, Knorr and Horlicks. If we see the revenue and EBIT split, the beauty and personal care division forms the largest portion of the company's revenue by contributing 19,460 crores, that is a revenue share of 38.8%. Also, the earnings before interest and tax for the beauty and personal care division stands at 5,354 crores, making it the business division with the highest EBIT margin of 27.51%. HUL has had a 5-year compounded sales growth of 10%, a 5-year compounded profit growth of 16%, and a 5-year compounded stock price CAGR of 17%. The return on capital employed for the company stands at 24.4%. Dabur is the 4th largest FMCG company in India. It is also the world's largest Ayurvedic and natural healthcare company with a portfolio of 250 plus products. Dabur has also been able to establish a goodwill globally With a presence in over 120 plus countries, the company's overseas revenue has been more than 27% of the total turnover. The company has a distribution network of more than 6 million plus retail stores. Dabur has leading positions in healthcare, home and personal care, and food and beverage space. Some of the most selling products of Dabur are Dabur Amla Hair Oil, Dabur Chyawanprash, Hajmola, Pudin Hara, Dabur Red Paste, Real Fruit Juice, Dabur Honey, Odonil, etc. Other than the 27% of revenue coming from the international market, the domestic revenue of the company is split between the three divisions as follows. The Home and Personal Care division has a revenue of 3,657 crores, making up for the largest revenue share of 47.2% for the company. However, if we talk about the fastest growing division, it is the food and beverage space with an year-on-year growth rate of 47.7%. Dabur has had a 5-year compounded sales and profit growth of 7%, a 5-year compounded stock price CAGR of 13%, and a return on capital employed of 27.2%. Tata Consumer Products is the second largest tea company globally. It has a presence in more than 40 countries. After the merger of the consumer products business of Tata Chemicals with Tata Consumer Products, the company has also become the largest salt brand in India. Tata Consumer Products also has a joint venture with Starbucks Coffee and currently operates 268 stores in 26 cities in India. Some of the prominent brands of the company are Tata Salt, Tetley, Tata Coffee, Tata Tea, Himalayan Water, etc. For these products, the company has a wide distribution network of 2.6 million plus retail stores. If we look at the revenue split of Tata Consumer Products, 26.84% of the turnover comes from the international beverage division. The remaining domestic revenue is split between the India Beverages and India Foods division. Currently, the growth driver for Tata Consumer Products has been the India Foods division, which had a spectacular year-on-year growth rate of 19% in FY22. The company has had a 5-year compounded sales growth of 13%, a 5-year compounded profit growth of 20%, and a 5-year compounded stock price CAGR of 32%. Lastly, the return on capital employed has been 9.61%. It is advised that you do your own research before investing in any of these stocks. Thank you so much for watching. Like the video, hit that subscribe button, and stay tuned for my next video.